all sanctions they're a fool's game. They never work. Trump's talking peace. He wants peace. He's a man of peace. The quickest way to get peace and to shut down the war in Ukraine and the Middle East is the U.S. cut the money off. It's just a perpetual war machine. The military-industrial complex more or less runs the show.
Steve Hanke returns to the show. He is a professor of applied economics at Johns Hopkins University. Professor Hanke, welcome back to the show. Great honor to have you on as always. Let's just jump right into the Iran-Israel situation. Currently developing situation. It's changing by the hour. You've been tweeting about this nonstop. You retweeted Rand Paul, Senator Rand Paul, on escalation with Iran. He says, "I don't consider war to be a game. Hundreds of thousands of people will now die. Iraq was a mess. Afghanistan was a mess. It's not the U.S.'s job to get involved in a war." As we're speaking, Trump has urged Tehran to be evacuated. Iran has struck government buildings and metropolitan buildings in Tel Aviv. And now Trump has talked about giving a 2-week deadline for a deal to be cut or further action may ensue. So that's the current situation. Again, it's developing by the hour. Now, what's your read on the situation? Will it develop into a full-blown war that could involve the U.S.? Or do you think something may, the Israelis and the Iranians have been lobbing missiles at each other for quite some time. Is this time any different from last year?
Well, you have to put things into context a little bit. As far as Senator Paul's concerned, I'm in general agreement with him. I mean, the U.S. has been in one bad war after another. When I say bad, they never generated any benefits for the United States or were of interest to the United States. Starting, okay, let's just take Vietnam, but and on and on. It's just a perpetual war machine. The military-industrial complex more or less runs the show, and there's not much to show for it. So I'm a peace person. In that sense, I'm very consistent with my kind of intellectual underpinnings, which is from Austrian economics and the Austrian School of Economics, if you will. Plus, I might add, one of my professors was the great Ken Boulding, who at the University of Colorado, who was one of the pioneers in peace research, actually. So that's kind of where that's the side of things that I'm on. Now, what is happening, and of course, Paul and I are in a minority because we just keep going into these stupid wars. So that's one aspect of it. The other aspect is to put the thing into context and what's going to happen. I think that President Trump is largely in the hands of the Prime Minister of Israel and the Israeli lobby. So I think that's where he's coming from, and we'll have to see what the final outcome of this happens to be. He said 2 weeks for a deadline for a deal. Well, what do you mean a deal? What deal? He's always in a deal mode. But I think this is a little bit more serious than, peddling real estate or whatever he happens to be doing in the past.
Okay. But just, I know nobody wants a war. I don't think President Trump wants a war either, because that's why he's extending the deadline. But anyway, do you think, though, I mean, nobody knows for sure, but just based on the current situation, how do you think things will progress from here? Will we get an escalation or a de-escalation? What does it look like to you? What does your gut tell you?
Well, I think if you take what I tried to be diplomatic and just say I think he's pretty much in the hands of Netanyahu, Prime Minister of Israel, and the Israeli lobby. So okay. Draw your own conclusion from that.
Well, what does Netanyahu want, do you think?
The big bomb. He wants to escalate. He basically wants to wipe them off the face of the earth. That is, the Iranians are actually the Persians, but Persia's been around for a long time, and it's not going to be wiped off the face of the earth.
Right, but the pretext is, of course, the Iranians are developing a nuclear bomb. Is that a genuine
We
threat?
we we we've been hearing that narrative from Netanyahu for 20 or 30 years. It's
Okay, so that's
it the narrative doesn't have very much credibility because we've been hearing it for a long time, and so far they haven't developed a bomb, but that is the narrative, and like a good used car salesman, Netanyahu's sold a lot of people on that narrative. Even though there's been no evidence and they haven't done anything, he's been able to sell it.
Can the two sides afford a war? That's my question. This is a perspective that I don't think is often discussed. Let's say they do get into a protracted war with each other, and let's say the U.S. does get involved somewhat, either by direct military action or with supplying Israel with weapons. I mean, economically speaking,
they're doing that? They're doing that already. The U.S. is financing most of this, and most of the weapons come from the United States. So it's a little like the Ukraine. Trump's talking peace. He wants peace. He's a man of peace. The quickest way to get peace and to shut down the war in Ukraine and the Middle East is the U.S. cut the money off. It's all finance and money. I mean, you raised the issue of affordability, but I'll raise the issue: who's financing all this?
Yeah.
So again, things always are much more complicated than that. But it's always good when you're looking at activity of one sort or another, economic or military or anything else, is to find out where the money's coming from, and if the U.S. stopped funding and providing intelligence and providing munitions for either the Ukrainian war or the Middle East, or the multiple wars that Israel is in the Middle East, they would come to a grinding halt in a hurry. David, it doesn't take a rocket scientist to figure this out. The thing is, no one talks about it. No one has the courage to talk about these kinds of things.
Certainly the Pentagon and the White House have looked at other options besides bombing Iran. Sanctions possibly are on the table. Why can't they just take that route?
Well, they have been taking that route. Since when? We got sanctions, more sanctions than you can shake a stick at. In both Ukraine and sanctions against Russia and sanctions against Iran. This has been going on for years, and of course, like all sanctions, they're a fool's game. They never work, and not only don't work to achieve their stated objectives, which is usually regime change is its stated objective in most cases. All they do is create a huge rally around the flag effect, which actually keeps whoever is being sanctioned in power. Why do you think Maduro in Venezuela has been in power for over a decade? It's because of U.S. sanctions. Why was Castro in power for so long in Cuba? Sanctions. Why do you think Putin is more popular now in Russia than he was before the war? Sanctions. Why do you think the mullahs are in power? Sanctions. So sanctions not only don't achieve their stated objective, but the history of sanctions, if you go back a long way at the beginning of the original sanctions, the first ones, you find that they also have a lot of collateral damage associated with them. Why do you think Europe is in the tank? Why do you think Germany is in the tank? Sanctions.
Yeah.
So that's another dumb option. I mean, war is obviously a dumb option, and sanctions are another dumb option. But sanctions are a means of warfare. These are not, something for patsies. They're, they're equivalent to declaration of war. Why do you think everyone talks about the governor of the People's Bank of China Wednesday gave a big speech, and he was talking about what? How the U.S. was weaponizing the U.S. dollar. And of course, his theme was the U.S. is weaponizing the dollar. So why don't you start using the Chinese RMB instead of the U.S. dollar? That was his pitch. But he used the word correctly, weaponizing the U.S. dollar and the dollar-based financial system. That's what sanctions do, financial sanctions.
So sanctions are off the table. Military action is on the table. Trump said he may or may not do it. He's not telegraphing anything.
I think sanctions are on the table. I took them off, David, but
never mind.
The Department of Defense didn't take them off.
Okay.
Unfortunately.
Okay. Well, Hanke is not the head of the Department of Defense. If you were the Department of Defense, though, what would you do? You got a situation brewing, and you're head of the Department of Defense, and and the president is probably giving you orders to come up with options here, right?
Well, one thing to wind it down in a hurry would be we sent a large chunk of the U.S. Navy is doing what? It's in the Middle East now, and more of it's going there. And what about all the aircraft that are been flying into bases, getting themselves set up in the last few days for more action in the Middle East? So I wouldn't have been for that. That's for sure. Saber rattling really is. I don't think a very wise.
Should the U.S. be prioritizing its military assets in the Middle East right now? I think before the election, reporters asked both candidates, but Kamala Harris in particular, who is the biggest threat facing America? What America's biggest enemy? She said, Iran. Some argue it's China. Is it Iran or is it China? What's a bigger threat that the U.S. has to contend with?
Well, if you're asking what Washington thinks, it's China.
Okay, and is that the correct assessment here? It seems like a lot of time and attention is given on Iran right now, but maybe China is still.
Yeah, that is a focal point. But all these enemies are you have to ask the question: Are they really enemies?
I don't know. Are they? What threat does Iran pose directly to the U.S., if anything?
Probably not much.
They could launch proxy wars, fund terrorism.
Well, about the only thing if they became proactive would be some terrorist type of activities.
Yeah,
they clearly don't. They can't shoot a gun and hit the United States. Let's put it that way.
Well, okay. Suppose the U.S. stops supporting Israel. Right, both financially and I guess economically, politically.
Well, what
would happen?
Well, we clearly would have a wind down of war making in the Middle East. There's no question about that.
Stabilize the Middle East if the Israelis lose an ally in the United States.
I'll let you answer it. You think they're promoting stability now, or instability?
No, I'm just saying. Would there be more of an incentive to, I guess, attack each other in the Middle East if the U.S. steps away completely? Well, I mean, it basically is the U.S. involvement a figure of stability?
I said cutting intelligence, cover, finance, munitions, that sort of thing off. We're not talking about disengaging with diplomatic activity and other things. So, at any rate, I think the thing has to be looked at in a realistic fashion. And I think I gave you when we started a pretty good reading on where I was standing. I was standing with people like Rand Paul, for example, on the side of peace, not the side of war, and certainly not the side of the neoconservatives. So that's where I'm coming from, and I did put something on the table that I think is realistic in my assessment. I think that the Israeli lobby and Netanyahu have a pretty good control over Trump.
Now, the FOMC meeting happened this week as well. Do you think that this war between Israel and Iraq would change the calculus of Jerome Powell and the other Fed governors? Basically, do you think with oil spiking, that may influence their decision to withhold rate cuts?
Well, it didn't affect them at all. The markets were saying for a long time, and this is before the hostilities got red hot and with Israel and Iran, that there would be no change in rates, and there wasn't. The main factor in terms of the geopolitics of the thing, with regard to the FOMC and the Fed funds rate, is really domestic. What Trump's doing, Trump's creating a lot of regime uncertainties. He's trying to change everything, including maybe even going to war, and that creates a tremendous amount of regime uncertainty. And if you have regime uncertainty, the Fed tends to stay quiet, not do anything. Everyone is in the same boat. If you look at the markets, surprisingly enough, the oil market did spike up a little bit, and then it backed off. Still, oil prices are higher than they were before last Friday when Israel first struck Iran. However, everything is kind of quiet because people don't actually know what to do, and it's kind of a deer in the headlights situation. That's the way the markets have been reacting. Nothing has changed very much. I don't think that's particularly wise, by the way. I think the regime uncertainty will lead eventually to what? Looking ahead, it'll lead to a more serious slowdown and a recession in the United States. And with a recession, of course, you have top line revenues going down, margins going down, profits going down, and the stock market, the PEs are going to come down. We are in a bubble, according to my bubble detector at the stock market. I think the regime uncertainty that's being thrown into the picture with all these things that are going on right now, not only domestic economic policy, but international. We spent a lot of time at the top of the program speculating and chatting about the Middle East. And then there was one point where we even threw China in there as the enemy of the United States. Seems like the U.S. has a lot of enemies now. So we're talking about that, but the markets don't really react much at all to it. And I do think the market is overhyped, overpriced, and is in a bubble. And when you're in a bubble, the air eventually comes out of the bubble or the thing pops. The problem is, David, it's almost impossible to predict when that's going to happen, and impossible to predict whether it's going to be a slow seeping of air out of the bubble and a slow adjustment, or whether it's going to be, some cataclysmic crisis where the thing pops all of a sudden.
Professor Hanke, let's talk about the FOMC meeting itself. Jerome Powell said that he expects inflation to rise higher this year. In fact, he made a very strong statement about inflation. Let me just play for you what he said exactly so we can respond together. It's quite a strong remark that he made regarding the Fed's outlook on economic growth and inflation. Take a listen.
So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. unemployment, again, as I said, low, labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months.
Every forecaster he knows is forecasting higher inflation. You're not forecasting higher inflation based on tariffs, Professor.
No, tariffs don't create inflation. Changes in the money supply create inflation, and the one thing that the tariffs could do is have a little one-time pop in prices, but then the prices would get on their trajectory and start coming down again. If that should occur, I don't think it will occur. It hasn't occurred because since April of 2022, there's been essentially no augmentation of the money supply, and the money supply is still growing at a rate that's only a little above 4% per annum. Yes. And the Hanke's golden growth rate, as I've told you many times, is about 6%, 6.3%, a rate consistent with hitting a 2% inflation target. So as we look now at the situation, by the way, all these forecasters, let me ask you a question, how many forecasters ever did the forecasting of inflation correctly? Well, Hanke and Greenwood did. None of the so-called professional forecasters he talked about did. Remember, transitory, nothing was going to happen, you name it. And using the quantity theory of money and focusing on the changes in the money supply, Greenwood and I nailed the top side, and we nailed the inflation rate coming down. And the inflation rate has continued to come down. It's 2.4% now. And it'll continue to come down. I think we'll see inflation numbers at the inflation target, or maybe even get a reading or two below sometime this year. And the reason for that is the money supply. It has nothing to do with tariffs. Tariffs can change the relative prices of things, but they can't change the overall price index. Or if they do, they can do it temporarily and not change the trajectory of where the price index is going.
Okay, so given that a temporary price increase is only going to be temporary, should they be cutting rates now then? Because
monetary policy is not about interest rates; it's about changes in the money supply. They should be stopping quantitative tightening. They're too tight.
Oh.
They're still engaged in quantitative tightening and shrinking the Fed's balance sheet, and not contributing to the growth in the money supply. They've been constraining it, and as a result, the money supply is in fact not. It's anemic. It's not growing as fast as it should grow if they wanted to hit the 2% inflation target. So he should be talking. I know it's the FOMC meeting, and he has to be talking about the Fed funds rate, but he should really be talking about changes in the money supply and changes in quantitative tightening, removing quantitative tightening. But he won't, because the Fed does not think the money supply has any effect on economic activity.
Okay, you know who has stronger language regarding the Fed is President Trump. Take a listen.
I do it every way in the book. I'm nasty. I'm nice. Nothing works. He's like just a stupid person. But I don't expect anything. Maybe he does a little bit, but we should be 2.5 points. Remember, Europe had 10 cuts. We had none. We're paying more rate, more interest than a lot of European nations that can't carry our suitcase. I'm going to be nice. It's another expression.
Okay, we should be 2.5% lower in terms of interest rates. He just called Powell a stupid person.
Well,
okay.
I think both the president and Powell don't know what they're talking about. Both of them are in the same. He was talking about suitcases. They're both in the same suitcase.
Okay.
They should be looking at changes in the quantity of money. Trump looks at the interest rate because he's a real estate guy. That's what he understands. He doesn't understand monetary policy. And Powell doesn't either, because he has rejected in testimony over and over and over again that he doesn't embrace the quantity theory of money, and that the Fed does not use the quantity theory of money as a guide, because they think there's no reliable link between changes in the money supply and changes in economic activity or inflation. So there you have it. Neither one of them know what they're talking about.
Why does Trump want lower interest rates, first and foremost?
Because he's a real estate guy. Real estate guys always want lower interest rates.
Does he want a weaker dollar? Does he want,
Well, we don't actually. Now you're getting into a zone where Trump has no plan. He doesn't know what the word plan means. You say, what does he want? Does he want the lower dollar? I don't know if he does. He's talked about that on occasion, but then on other occasions he's absent without leave when it comes to talking about the dollar.
What's your view on the big beautiful bill? We haven't talked about that. Elon Musk left Doge because he had a disagreement.
I think it's a terrible bill. It doesn't. It continues with a very large fiscal deficit that will have to be financed eventually either with higher inflation or with more issuance of bonds and higher interest rates. So it's got a deficit. It's adding to a huge debt level that we already have, and there's no restraint on government spending. And in fact, getting at my earlier comments about peace, it has a huge increase in the Defense Department budget. I'm against it. They should be cutting the Defense Department budget's probably 50% greater than it should be. They should be slashing it. So it's basically a big, bad, terrible bill, not a beautiful bill, as far as I'm concerned. A lot of government spending, and by the way, when you talk about, we love to talk about waste, fraud, and abuse. By the way, and where do you have most of it? Most of it in the budget actually is in the Defense Department. The Defense Department's the only department or agency or bureau in the U.S. government that's never been able to be audited. They can't even audit the darn thing.
So we don't need a.
It's such a maze of things, and it's all wrapped in the flag. You see, here's the problem with this. Once you wrap something in the flag and say it's for national security reasons, then you can't have a logical argument about it. Mm-hmm. It's national security. It's off base. You can't talk about it. Our national security is involved, so we have to increase the Defense Department budget by, Lord only knows how many $billion. So that's my take on the budget. I think it's bad.
Are you saying we don't need a space force, Professor? Are you saying the Department of Defense is big enough already and needs to be leaner? I don't know. Just making it.
Well, let's put it this way. I think, and there are other people, knowledgeable people, by the way. One of my former colleagues, who was the head of the Office of Management Budget under Reagan, when I was on the Council of Economic Advisors of Reagan, is David Stockman. And David Stockman and I agree. We think the Defense Department should be slashed by about 50%. Now, Stockman's a sharp pencil guy who knows what he's doing, by the way.
But just going back to the economy for a minute, you the recession's baked in. You've been telling us about that. Do you think then that the Big Beautiful Bill and more fiscal spending in general can alleviate this recession? Will it help us?
No.
So government spending is not the solution to staving off a recession?
No.
I mean, has that worked in the past when the government just spent its way out of a recession?
Right now, there's no immediate thing that you can do, because this is a slow-moving train. Once you get these contractions in the money supply, with long and variable lags, they ultimately affect economic activity, and that's what's happening. Finally, the train, I think, the second half of this year will arrive, and things will continue to slow down. A lot of the soft data that we have, David, for those that are data dependent, they can already see softening. When you look, for example, at there was a piece in the Wall Street Journal a couple of days ago about how college graduates are having a very tough time getting jobs in the United States. And the reason for that, you see, is the following. If you hire some college graduate, you're investing in human capital. That's an investment. If you're an employer, you're making an investment in that newly graduated student from college, and you're making an investment because you've got to spend a lot of time training them on how to do a job. That's an investment. And with all the regime uncertainty created by Trump, people are sitting on their hands. They don't want to make investments. And that's what happens with regime uncertainty. And when you don't want to make investments and don't invest, the economy slows down. So we have the money supply part of the picture, and we have the regime uncertainty created by a lot of these policies that Trump has put in, or we don't know what they put in. The tariffs, can you tell me what the final tariff picture is going to look like? No one can. Not even Trump. Trump has no idea what the final picture is going to be.
Well, can we use the first term of Trump's presidency as a guidepost?
Not really.
No, you think this time he's going to do
whatever he wants? Not really, because we don't know when we're talking about tariffs or other economic policies. We don't know what the second term is going to be, because Trump has told us very clearly that it's going to be different than the first term. He's already said that.
By the way,
you've got this regime uncertainty. Now, let me remind you, and viewers, the last time we had big regime uncertainty where everything was being changed was with the New Deal and Franklin Delano Roosevelt in the 1930s. And what happened with that regime uncertainty is that investors who were going to invest or thinking about invest, they just stopped. And there was no investment from 1929 until the Second World War started. And as a result, the Great Depression was a lot deeper and lasted a lot longer than everyone thought it would, or it should have. And that was because of the New Dealers.
Okay. This is what Powell had to say about the labor market. Take a listen.
What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. I mean, at the margin, remember, you're at 4.2% unemployment. That was for many, many years, that was an extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation, given a reasonable assessment of trend productivity.
Okay, how concerned are you about the labor market? And is he right that the labor market overall looks pretty good?
Well, I think the questioner, the journalist, who I don't know who that was, asked the right question. If you look under the hood, at the labor market, it is getting is at the margin, as Paul used that word, at the margin. It's getting softer, not stronger. It's getting weaker. He obviously, by the way, what Paul said he believes, because believe me, if he thought the labor market really was showing significant weakness, they would have lowered the federal funds rate, because the Fed watches the labor market more closely than anything else. They don't watch the money supply, but they do watch the labor market.
Okay, so bottom line, if you were at the Fed, would you be lowering rates now, given that on the margin maybe?
I wouldn't be paying attention to rates. I told you I'd be paying attention
Oh,
to money supply, and I'd be cut. I would have cut quantitative tightening a long time ago.
so you would keep rates unchanged. That doesn't matter to you.
I think that's a second order or third order condition. The first order condition is how to get the money supply
But
up.
if the president calls you, hey, Mr. Hanke, we need you to lower rates, you would say, forget that. I'm ending quantitative tightening instead.
Yes.
Okay.
I'd have a little explanation of why changes in the money supply are really what drive the economy. And Mr. President, if you really want the economy goose, the best way to goose it is to make certain that money supply comes off of its anemic level of a little over 4% and gets up to around 6 or maybe a tad over 6, and we keep it steady at that 6% rate. That's what we want to do. We want to get off the roller coaster that we're on. We want to get things flying at cruising altitude, 6% money supply growth, M2.
Is there a scenario, is it common for the money supply to, let's say, increase, but we don't actually have economic growth? In other words, we have a liquidity trap where there's more liquidity, but it's not actually being spent. It's not actually being invested. Is that,
No. The determinant of nominal national income or nominal GDP, which includes remember, the nominal is real GDP growth plus inflation, is determined by changes in the money supply, the broadly measured. You got to be measuring it right. And my preferred measure is actually Divisia M4, which you can only find that number at the Center for Financial Stability in New York. Professor Barnett supplies that, and that's
yes.
But
what if consumers? Sorry, please continue.
Yeah, so it's all about changes in the money supply. What's happening to changes in the money supply prior to today? A year ago, 2 years ago, what was happening in the money supply is gonna tell you what's going to happen today or tomorrow.
Right, but in order to, let's say, increase the money supply, they lower rates, but there's a lot more cash now in the system, but people prefer to hoard the cash instead of investing it or spending it or consuming with it. In that case, the money supply goes up, but nothing happens, right?
Yeah, if that was that's a hypothetical thing. I mean, yeah, that would happen. But that's not the way it works. The way it works is that people have a desired level for the cash balances that they have, meaning all you have to do is divide GDP into the money supply number, M2 or M4, whatever it happens to be, and that'll be the cash balance. And that actually increases. That's a demand for money. It increases at about 1.7% per year. So it stays on a trend. It doesn't flop around. The only time we've actually really gotten off of that trend, and there was a huge increase in the cash balances that we observed in the United States recently, was right after the pandemic. The money supply was growing so fast that people, it wasn't that they were hoarding, they were just overwhelmed with cash balances. So we did get a little bit off of that trend and had a huge surplus of cash balances that got built up in the system because the money supply was growing so fast. It was just people couldn't spend it that fast. They were just overwhelmed with cash. So what happened with that huge buildup and that excess of cash balances, people did spend that. But that's one reason, by the way, that Greenwood and I didn't get our prediction of when the slowdown in the economy would occur. We thought it would occur earlier than it did, but the reason it didn't is that people were working off that excess in the cash balances that they had, and it was taking a lot longer for that to get worked out of the system.
Mm-hmm. Okay.
Which, by the way, it did late last summer. Now we're in a kind of, shall we say, a more normal situation.
Let's close out the conversation on investments for a couple minutes. So, given this uncertainty, we don't know what the end game for the tariff situation is going to look like. What do investors do? We can't, we don't know what's going to happen. So I can't position myself one way or the other.
Well, I think the one that has anticipated the thing very well, and not surprisingly, is Berkshire Hathaway. Buffett has built up a big pile of cash that he's sitting on, and he's sitting on the good stocks that he likes, and just biding his time. Obviously, waiting for the bubble to deflate or pop, one of the two. So there's that. There's obviously gold. If you think this world that we're in is uncertain, what do? Have a little gold.
Little known fact about you. We'll close off here. You were a very successful currency trader. Now, if you were to go back and give yourself some advice to a younger self, or just any rookie or beginner investor looking into Forex or anything else, any words of wisdom?
Well, I think the best thing is to follow the Feynman's rule. Professor Feynman, late Professor Feynman from Caltech, and that is, you've got to be enthused about something, and you've got to be willing to spend thousands of hours studying it.
Well, how do you study trading? I mean, do you?
Well, I mean,
you have to do it.
There's more literature on it than you can shake a stick at. So there's quite a bit. There's quite a bit of literature on it. So that's the study part. That's one thing. But the other thing is to get associated with somebody who knows what they're doing and can train you. Now, fortunately for me, I was trading and hedging, of course, when I was a kid in Iowa. At my grandfather's knee, so that was one training. But the kind of second level of training that I got into was in 1985 when I joined Albert Friedberg at Friedberg Commodity Management in Toronto. I mean, it happened. The guy's one of the best traders going. So get at the knee of somebody who's experienced and knows what they're doing, and they have a lot of experience. That's one aspect. But the other aspect is thousands of hours of studying things. So that's the 1-2 punch. Get around somebody who can mentor you very well. And point number one, and point number two, be willing to put your nose to the grindstone and spend thousands of hours studying.
Excellent. What can we study from you?
The thousands of hours with your nose at the grindstone didn't seem to excite you very much.
I was not a good student. I love studying, but I unfortunately was not a very good student. I learned things by doing.
But that's the point. Now this does get to a point, and that is, you have to spend thousands of hours doing something. You have to be enthused about it. So you got enthused about what you're doing. And you're doing it, and doing it successfully. So the enthusiasm factor is key. You're not going to be able to do the Feynman technique, and anyone can Google, by the way, Feynman and find out what I'm talking about in the thousands, if not 10,000s of hours. But the first step is you have to be enthused about something. If you're not enthused, how are you going to be spending all that time studying it? It's not going to happen. And then the second thing is you got to be lucky enough to get around a mentor who actually can really mentor you and teach you.
I have one final question for you. This happens to a lot of young people. They get into college, they study something, and they realize they don't love it. Most of them stick through it. But in that situation, what should they do? Like going back to what you said, you have to be enthused about it for you to spend thousands of hours doing it. So
Well,
you study something, you're not enthused. What do you do?
There are various aspects to get hooked with the enthusiasm thing. In my case, I'll give you a personal example, which I think is something that can be generalized. They should stick with the professors who excite them. Unfortunately, there aren't very many good professors around anymore. I had a lot of good ones that were very exciting. And in fact, David, one reason I am a professor is because I wanted to be like them. They were excited. I thought they were exciting, and what they were professing was exciting, and got me on the track that I'm on. And as a result, I've been a professor now for almost 60 years, and I've just never, as the old line, I've never worked a day in my life. I mean, we're doing our interview. Why are we doing? I'm having a good time.
Absolutely, me too.
Yeah. So that's the name of the game. And I, by the way, I've had thousands of students, and very few of them actually get hooked on things that excite them. It's very depressing to watch. But what most of them are what I call careerists. They're going through the mill, getting their union card, their degree, and going out and in a job that has no pizzazz, no excitement for them, and they come back and see me, in 20 or 30 years, and many of them, it's kind of a sad sight. There are a few that isn't the case. They are enthused. They're not.
Part of it, yeah.
I think my advice is stay away from being a careerist. That's deadly.
Part of the problem, I'll give you some of my experience from my days at university. You would go into, I studied finance, and most of my classmates studying finance wanted to work on Wall Street. You ask them why, nobody really knew the answer. They just wanted to make money, and that was the kind of the prestigious jobs to get. And that's what society told them they should do if they were studying finance, right? So that begs the question, why were they studying finance and economics to begin with? Well, nobody really knew, actually. So, young people, they go into college kind of finding themselves, but they don't really know what they want to do. So most of my classmates that I was friends with ended up working on the investment side for a few years, and they quit, and now they work in something that has nothing to do with their major. Which is kind of a shame because they wasted several years doing something they didn't like doing. How do young people go about finding what they want to do in school? Because you apply to university, you already select your courses or your major in most cases. So you don't have really an opportunity to find yourself during those 4 years. Is my experience.
I think that's correct. A correct assessment, and I think unfortunately the way universities are structured now, they're not they're in this careerist thing. Everyone gets in a silo. When you enter and you're in a major, when you apply now, they actually put you in a major, and you're on that track. It's hard to get off the track. It's hard to, so the idea of a general education, a more liberal education, is basically for the birds now. We're into this STEM thing. Everybody's very narrowly focused. So it's very hard for them to find themselves. The way things are structured now, it makes it much more difficult to do what you and I were doing, where we had more flexibility. I'm for more flexibility so that people actually can do a little shopping around and figure out, maybe land on something that turns them on, and because if you go through university and you haven't been turned on, you're just getting the grades, filling up your and all of that stuff. It's just deadly.
One final question, and I'll end it here. What about the idea of, let's say, a liberal arts education, which is what a lot of Ivy Leagues offer? You do 4 years without a major. You just kind of study whatever you want, and then you enter the workforce for a few years, and then you finally pick your specialty in your master's program. What do you like that idea, that route?
It's okay. I mean, the way you described it in principle, yeah, that sounds okay to me. Get a liberal arts, a general liberal arts education, and then focus in a little bit later on. The big problem is that they're forcing a lot of specialization very early and a lot of inflexibility very early, and
Yeah.
And if that isn't for
Do you feel like
you got a big problem.
Well, do you feel like a person becomes more well-rounded if they study a broad array of topics
Yes.
when they're younger? Yeah.
Yes.
Okay. Instead of doing a specialty right away.
So one of my best students now, he just graduated. He's got a big time job on Wall Street like all my
Sure.
students. What did he do? He had a dual major, one in economics and one in classics, reading the classics. So he was taking Latin and Greek and things like that. And then he had a minor in pure math. So that is maximum flexibility, and with a minor in math, I mean that was heavy duty. So he had the STEM part of the thing. He had the broad education part of the thing, and with the classics and economics. You can do it, but the guy was working his tail off. He was my assistant, but every time we would leave the office together at the end of the day, I'd ask him where he was going, and he says, "I'm going to the library."
Yeah. Hardworking guy.
Yeah. So
All right.
that's the Feynman technique. But that's my point. He was enthused about this. He was enthused about what he was doing, and as a result, he was putting in thousands of hours.
Mm-hmm.
And we were writing articles together and all kinds of things. So and I can attest to the fact that he got a top flight job on Wall Street, and I can assure you he'll do very well.
Let's end it here. Another discussion for another time. This is very fascinating, getting your insights on education. Where can we learn from you in the meantime? Follow you?
Follow me on X, and
Okay.
that is at Steve_Hanke, at Steve_Hanke. I'm up. I've got a little over 803,000 followers now, so put out a lot of stuff every day.
Thank you, Professor.
Hey,
And
great,
we'll put the
great,
links down
David.
below.
Great to see you.
Great to see you as well. Let's speak in a couple of weeks. Bye-bye.
Okay, good. Thank you.